Namaste candidates. Let's cover this chapter credit risk of the FRM Part 2 curriculum today. Now this chapter is one of the latest additions in the credit risk measurement and management modules after the last round of revision was made in the syllabus. Now GARP has based this reading on one of the chapters of the book Options, Futures and Other Derivatives, the popular book, in fact 11th edition of that book by John C. Hull. So let's begin. Okay, let us quickly look at the learning objectives. Assessing the credit risk of derivatives, defining CVA, DVA, calculating probability of default using credit spreads, describing, comparing and contrasting various credit risk mitigants and their role, then significance of estimating default correlation and differentiation between reduced form and structural form models, then Gaussian-Coppola model for time to default and calculation of PD using the one factor model. Now this has already been covered in earlier chapters, including the credit VAR chapter. So we'll cover it in very, you can say, brief. At this last learning objectives, how to estimate credit VAR using the Gaussian-Coppola and credit metrics approach. So this is exactly the same how it has been covered in the credit VAR chapter. So we'll skip this learning objective completely. Okay. So let's start with the first learning objective. Okay, let us start with credit risk in derivative transactions. The first point, bilateral derivatives and ISDA. So typically bilateral derivative transactions between two companies, between two counterparties, they are governed by the ISDA master agreement. That is the International Swaps and Derivatives Association's standard framework, you can say. Okay. Then when it comes to margin requirements, see, when we talk about trades between financial institutions, regulations require that they exchange variation margin on a daily basis and post initial margin with third parties. Of course, this margining process, it will help keep the counterparty exposures under control. Now, initial margin calibration, if you see, the initial margin is calculated so that it covers potential losses over a 10-day horizon with a 99% confidence. So it's meant to protect both sides, even if markets move sharply before collateral can be adjusted. So that sets the foundation, you can say. Okay. Now we'll see what happens when one party defaults under this agreement. Now, event of default. Any event of default will happen when a counterparty fails to make the required payments, fails to post collateral, or declares bankruptcy. So when any of these events occur, the non-defaulting party has the right to terminate all outstanding transactions immediately. Okay. Now, when these losses occur, even after termination, losses can still occur. They happen when the exposure exceeds the collateral posted by the defaulting party, or when the non-defaulting party's collateral exceeds its own exposure, which leaves that excess amount unsecured. Okay. So even with collateral and margining in practice in place, bilateral derivative trades still carry some unsecured exposure. And that is the essence of credit risk in derivatives transactions. Okay, let's begin with the basics of CVA and DVA as introduced back in one of the earlier chapters. Now, CVA is the present value of the expected cost to the bank if the counterparty defaults, and DVA is the present value of the expected cost to the counterparty if the bank itself defaults. And because the bank's own default would mean some payments might never be made from the bank side, DVA is actually a benefit to the bank. So it increases the value of its derivatives portfolio. Okay, so that's our base, CVA, DVA, and where they come from. Okay, now let us connect these adjustments to portfolio value. So we start with the no default value FND from standard models like Blass-Scholes Merton models. When we allow for default risk, the value to the bank becomes FND minus CVA plus DVA. Now to compute CVA and DVA over time, we take the longest maturity T, split 0 to 2 into n intervals, you can say, and then we work interval by interval. And of course, then we use the formula, the summation of Qi Vi for CVA, where Qi is the risk neutral probability of the counterparty defaulting during the ith interval, and Vi is the present value of the expected loss to the bank if the counterparty defaults at the midpoint of the ith interval. Okay, so we have assumed midpoint because our calculations will become easier. Similarly, DVA is equal to Qi star Vi star, where Qi star is the risk neutral probability of the bank defaulting during the ith interval, and Vi star is the present value of the expected loss to the counterparty if the bank defaults at the midpoint of the ith interval. So basically, we have just changed the perspective for DVA. Okay, now how do we estimate Qi and Vi? So consider first the calculation of Q. Now to find the default probability Q, we'll first collect the counterparty spreads for several maturities. Okay, then we'll interpolate to get STI, or the counterparty's credit spread for maturity TI, you can say, for each time point I. Now again, I'm repeating that Q should be a risk neutral default probability because we are valuing future cash flows, and we are implicitly using risk neutral valuation. And of course, we assume some recovery rate. Now the average hazard rate up to time Ti is STI over 1 minus R. Now the chance of survival, not defaulting, up to Ti is given by e raised to the power negative S times Ti, or you can say S of Ti times Ti. It's just a function that we have calculated, the value of the function we have calculated, divided by 1 minus R. Okay. Then what is the probability of defaulting in that particular time interval? Okay, so between I minus 1, or you can say Ti minus 1 to Ti, what is the probability of default? This is the probability of default. Qi is equal to e raised to the power negative of S Ti minus 1 multiplied by Ti minus 1 divided by 1 minus R minus e raised to the power negative of S Ti times Ti divided by 1 minus R. Now this must be ringing a lot of bells because we have not only done this in part 2, we have also covered the same idea in FRM part 1 as well. If you remember, e raised to the power minus lambda 1 T1 minus e raised to the power minus lambda 2 T2. Okay, of course, if lambda is same, then it will be lambda and lambda in both the terms above, you can say as a power of e. But this is an equation, this is the idea that we repeatedly use to find out the default probability in an interval. Okay, either it can be calculated using the differences between survival probabilities, or you can take it the other way around. You can also calculate it as the difference in cumulative default probabilities, only the order will be different in both. Okay, so we have done this in FRM part 1 also. The same idea is being used. And to calculate Qi star, you just repeat the same process for the bank's own credit spreads. Now let us discuss estimating expected loss amounts. So we'll start with the first case without collateral. Now to estimate the loss values VI, we actually run risk neutral simulations up to the portfolio's horizon T. Now at each midpoint, we calculate the value of the portfolio, let's call it V. Exposure is just the positive part, max of V and 0. Okay, then we take the average exposure and discount it, find out its present value, multiply it by 1 minus R to get VI. Okay, we do the same from the counterparty side to get the value of VI star. So VI star is derived from the counterparty's exposure to the bank. Now, when collateral is involved, things actually change slightly and become a little more complicated. So with collateral, we add another layer. We estimate how much collateral would be held at the midpoint if a default happens. We assume collateral posting and returns stop just a few days before default, let's say C days before default. That's called the cure period, usually 10 to 20 days. Now, in order to know what collateral is held at the midpoint of an interval in the event of default, it is necessary to calculate the value of the transactions C days earlier. Okay, that tells us what collateral would be held at the midpoint if a default happens. So finally, VI becomes the present value of the average collateral adjusted exposure multiplied by 1 minus R, and VI star is calculated in exactly the same way, just from the other size perspective. Let's take an example of estimating expected loss amounts with collateral. Okay. So uh, this is the first case. Basically, we are taking the first simulation trial, you can say. At time t, the value of the derivatives to the bank is 50, and it 20 days earlier, okay, say it C is 20 days, it was 45. So the cure period is 20 days, and this earlier value 45, it represents the collateral already posted by the counterparty when the default occurs. So if the counterparty defaults at time t, the bank holds a collateral of 45 while the exposure has now risen to 50, which means that the uncollateralized portion is 5, and this becomes the bank's exposure, which is the part it stands to lose in case of default. Next case, let's say VT is 50 and VT minus 60 was equal to 55. So basically counterparty posted more collateral. Okay, 20 days earlier the value was 55, so the collateral was of 55 had been posted by the counterparty, which is more than the portfolio's current value. So even if the counterparty defaults at time t, the bank is fully covered. It actually holds more collateral than the exposure. So in this scenario, the exposure is actually zero, which means again no loss to the bank. Now, if you're still getting confused why the collateral I'm just directly taking as 45 and 55, remember what we discussed earlier. We discussed that we have to use the portfolio value C days earlier to determine the collateral held at the default time. Okay. So let's continue. Let's continue with the third trial. Let's say this is the case. Vt is equal to negative 50 and Vt minus C is equal to negative 45. So we are flipping the direction now. Okay. The value to the bank is negative 50, means that the exposure is actually on the other side. The bank owes the money to the counterparty. 20 days earlier, the value was negative 45, which means that the bank had posted the collateral of only 45, less than the current liability of 50. So if the bank were to default at time t, the counterparty might lose part of this difference, this five, okay, $5 or $500 or $5 million, depending upon how we are scaling it. So in this case too, the exposure for the bank is actually zero. The exposure is for the counterparty, not for the bank. Next trial, Vt is equal to negative 50, Vt minus C is equal to negative 55. So the bank had posted collateral worth 55, and at the time of default, the counterparty is still holding that full amount, and it is assumed that none of it is returned after default. So this extra 5 above the bank's actual liability, it represents the excess collateral that gets trapped. So in this trial, the bank's exposure is actually 5. Okay, this time because it posted too much collateral. So across these 4 simulation outcomes, you can see how exposure depends on the timing of collateral posting and the movement of portfolio value during the cure period, okay, or the MPO or margin period of risk. So what is the key takeaway? Even with daily margining, a little bit of delay before default in posting collateral, either way, okay, it can lead to an exposure, and that is what CVA calculations tend to capture. That is their intention. Okay. Okay, now just let's discuss quickly peak exposure. What is happening over here? See, along with the CVA, banks track the peak exposure. Basically, you can say high percentile of all the simulated exposures. So at 97.5% with say 10,000 trials, that's the 250th highest exposure. The maximum across all the points gives the portfolio's overall peak. Now to speed things up, banks store all the simulation paths and valuations. So when any new trade arrives, they just value it on those stored paths to see how CVA and DVA are going to shift incrementally. So if the value of the new transaction is positively correlated to existing transactions, it is likely to increase the CVA and DVA. But if it is negatively correlated to existing transactions, maybe because it is maybe wholly or partially unwinding those transactions, it is likely to decrease the CVA and DVA. Now, the method for calculating CVA that we discussed, it actually assumed that probability of default by the counterparty is independent of the bank's exposure. Okay, that is a reasonable assumptions in many cases. Now, traders use the term wrong way risk to describe the situation where the default probability is positively correlated with the exposure, and the term right way risk to describe the cases where the default probability is negatively correlated with the exposure. Now, more complicated models than the models that we discussed, they have been developed to describe dependence between default probability as well as exposure. Now, a bank has, say, one CVA and one DVA for each of its counterparties, and the CVA and DVAs, they can be regarded as derivatives, which change in value as market variables change. Say counterparty credit spreads change and bank credit spreads change. Now the risks in the CVA as well as DVA, they can be managed in the same way as the risks in other derivatives using Greek letter calculations or scenario analysis. Now let us look at how banks actively reduce credit risk in derivative transactions through credit risk mitigation techniques. Netting arrangements. Now, one of the most effective ways is netting. Rather than treating each transaction separately, all the trades with a counterparty are combined into a single net exposure, you can say. So, if a bank has, let's say, one deal worth of, say, plus 10 million, another is worth, say, plus 20 million, okay, and let's say there's another deal worth negative 23 million. So, total exposure will not be 10 plus 20, which is 30, because in that case, they are being regarded as independent transactions. There was another deal, negative 23 million exposure, which means the counterparty has the exposure. That also has to be taken into account. So the net exposure, you can say, with this netting agreement will be 10 plus 20, and what we considered one more, negative 23. So 10 plus 20 minus 23, which is how much? Which is just 7 million. So that is the power of offsetting gains and losses under this single legal agreement. Next, collateral agreements. So this is also one of the major mitigants, collateralization. So here the counterparty must post cash or securities to back its position. If the counterparty defaults, the bank can seize the collateral to offset losses. And this is how a regulatory, this is actually a regulatory requirement, you can say, for most of the financial institutions, and collateral is usually held under the ISDA credit support annex. Then we have downgrade triggers. This is another technique. It is basically a clause that says if your credit rating drops below a certain level, I can ask for more collateral or close out the trades completely. So it's a preventive tool, but only works if it is used, you can say, sparingly, sporadically. Okay, if every dealer demands downgrade protection, it can actually make the system very, very fragile. Okay, like a feedback loop when ratings even fall to some extent. So a classic example you can say is AIG in 2008. Okay, AIG had sold credit protection on a large number of AAA rated CDO tranches, and its contract said it would not have to post collateral as long as its credit rating stayed above AA. But when all three rating agencies, Moody's, S&P, and Fitch, they downgraded AIG below AA in September 2008, it immediately faced massive collateral calls. So the company could not meet those margin requirements. We have seen that earlier in many chapters we have discussed. And that liquidity crunch, it pushed it to the brink of collapse. And a massive US government bailout was needed, right, to prevent bankruptcy. So downgrade triggers can actually amplify, you can say, this systemic stress if they are used excessively. So these three mechanisms, netting, collateral, and downgrade triggers, they form the foundation of how banks protect themselves against counterparty risk before it ever becomes a loss. Okay, let's discuss collateralization in practice. Now, collateral as protection. A collateral is really you can say, the frontline defense in derivative credit risk. It can be cash, which usually earns interest, or it can be marketable securities, which might face a haircut to reflect the market risk. A collateral is governed by the Credit Support Annex or CSA, as I said earlier, under ISDA, which sets all the terms. Now, in case of default, The non-defaulting party simply keeps the collateral. There's no need to go through a long legal battle. This makes collateralization both efficient as well as reliable. It cuts down legal delays and ensures that the process is standardized across institutions. Okay, example role in CVA. In CVA modeling, collateral plays a major role. It directly reduces the expected exposure of the counterparty, which means a lower CVA. However, maintaining collateral, of course, has costs, margin calls, funding requirements, and liquidity pressure. So it's not risk free operationally. Okay. Now, in short, you can say collateral turns unsecured exposure into secured exposure, trading credit risk for operational effort and funding cost. Now, let us discuss some special cases. Now, when Monte Carlo simulation is not needed, see, sometimes you don't need full scale simulation to calculate the value of CVA. If you are dealing with a single uncollateralized trade, say one bond or one option, you can derive it analytically. Now, let's take the first case, single derivative exposure. So if a bank holds, say for example, one derivative that has a payoff at maturity only, its exposure is simply the current no default value multiplied by the probability of default adjusted for the recovery rate. So this gives us a very simple formula, 1 minus r multiplied by no default value multiplied by the sum of all the default probabilities across time intervals. So it can be used when derivatives future value is independent of exposure correlation. Another case is the case of a forward contract. You can clearly see that in this case, the exposure is nothing but max of this term, comma 0. So there is exposure only if Ft is greater than K. So you can estimate this expected exposure using the volatility and the risk-free rate all directly from basic pricing models. Now, how to interpret this part? See, what these special cases tell us is that the impact of credit risk can be viewed as a discount on a derivative's value. So it's like using a higher discount rate that includes the counterparty's credit spread. Okay. So even without complex Monte Carlo simulations, analytical CVA gives a clear picture of how credit quality feeds directly into valuation. All right. Let us move on to one of the most crucial parts of this chapter, default correlation. So default correlation simply means that defaults don't happen in isolation. If one firm is failing, others also, especially those with similar risk drivers, they might follow. So it is about how likely defaults are to cluster together. Why does this happen? What are the key risk drivers? First is, of course, industry and geography. Firms in the same space share the same economic winds. Any regulatory change or a commodity price drop can hit all of them hard. Second, economic cycles. During recessions, liquidity dries up, revenues shrink, and defaults happen together. And third is credit contagion. This is when one company's failure weakens its partners, you can say suppliers, customers, lenders, leading to some kind of a chain reaction of defaults. So higher default correlation means that a greater chance of multiple defaults at once, and that is exactly what stresses these credit portfolios because diversification stops working. Which brings us to why estimating this correlation is so important in credit risk analysis, and we'll see that in the subsequent slides. Why default correlation matters? See, estimating default correlation is critical for portfolio risk assessment. If two exposures tend to move together, your overall portfolio risk can spike, even if each exposure looks safe on its own. Now, there are diversification limits. See, diversification works only if risks are independent. But when defaults are correlated, spreading your portfolio across 10 names in the same industry doesn't actually diversify much. Okay, it just duplicates the same exposure. Then tail risk, the biggest danger. Tail risk, those rare but massive losses, when defaults cluster, losses actually compound, and that's what turns a bad quarter into a crisis, you can say. So understanding correlation is not just academic exercise. Okay, it shapes capital, pricing, and strategic risk limits. So let's talk about correlation applications in practice. Application 1, pricing credit derivatives. In practice, default correlation feeds directly into pricing models. When modeling instruments like CDOs or CDS portfolios, correlation determines how likely multiple names default together and therefore what premium investors should demand. Regulatory capital. See, under the Basel 3 frameworks, regulators require banks to hold more capital when exposures are correlated. Why? Because one large default can quickly become a systemic event. Then stress testing and scenario analysis. Default correlation, of course, it also drives stress testing, where we simulate how defaults might cluster during recessions or credit crunches. It helps to identify different vulnerabilities before any real crisis hits. And one of the very important applications is in strategic decision making. It influences day to day strategy, how credit limits are set, asset allocation is done, concentrations are managed, etc. Okay, so in short, you can say understanding and estimating default correlation lets institutions see beyond individual credit risk and manage the systemic dimension of credit portfolios as well. Okay, we'll discuss types of default correlation models. Let's start with the first type, the reduced form model for default correlation. So, in a reduced form framework, we don't model the company's actual balance sheet or assets. Instead, we use a hazard rate, which represents the instantaneous probability of default. This hazard rate, as has been discussed in earlier chapters also, it moves randomly. That is stochastic, you can say, stochastic process. Now, the link between firms comes from shared macroeconomic factors or variables. So, if the economy slows down or credit conditions tighten, hazard rate across multiple firms will rise together. Okay, so when the hazard rate of company A spikes, there is a good chance that company B's hazard rate also spikes. That is what creates default correlation. Now, what are the advantages? These models are popular because they are mathematically clean and easy to calibrate to market data. They reflect the fact that economic cycles they actually drive defaults, but there are limitations also. Even if two firms are perfectly correlated in their hazard rates, the probability that both default in the same short time window still stays quite low. That's not ideal if you are modeling tightly linked companies, say two banks or two firms in the same supply chain. Okay, so to handle these tighter relationships where default events can really move together, we'll turn to structural models. Okay, so structural default correlation models. Now, structural models take a more intuitive approach. They are based on the Merton model, where a company defaults if its asset value falls below the value of its liabilities. Okay, that is the default point or threshold, you can say. So here the correlation comes from the co-movement of the asset values. If the assets of company A and B move together, say because they operate in the same industry or share the same risk factors, then the chances of defaulting together actually rise. So the advantages, the beauty of structural models is that they can produce any level of correlation you want simply by adjusting the correlation between asset, processes, and classes. They also give you a clear economic story behind each default event. It's not just about probability, it's about financial deterioration as well. Okay. But of course, there will be limitations. They are computationally much heavier. Simulating correlated asset paths across many firms for large portfolios, it takes a lot of time, which can be quite challenging. Okay. So, in essence, these reduced form models, which we saw, they were quick, flexible, macro driven, while structural models, we are seeing they are deeper, economically rich, but computationally more demanding. And we have a separate slide where we are just comparing them very quickly since we have already discussed most of the features. So the core idea for reduced form was that they were modeling default via stochastic hazard rate, whereas for structural, they were conceptual in nature, where default happens when the value of the asset is less than the value of the liabilities. Source of correlation for reduced form models were shared macroeconomic factors. Over here, they are correlated asset returns. Advantages for reduced form models, they are mathematically simple. allow high correlation, intuitive in nature, but both of them are having their own limitations. Sorry, allow high correlation, intuitive are for structural models. Limitations for reduced form models are that they are having low joint default probability, and for structural models, their limitation is they are quite mathematically intensive. Okay, let's talk about one of the most influential, you can say. Sometimes it's also one of the most controversial tools in credit risk modeling. The Gaussian copula model, we have discussed this multiple times. So I said this earlier also, we'll keep this quite brief. Now, purpose, it helps to identify how defaults across firms are correlated in time. Okay, that is how two or more companies are to default close together. Now, each company, what is the concept? Each company has a random variable Ti representing its time to default. We can estimate its default probability distribution either from historical data or market implied data. Then you have the copula function. It connects these distribution to create a joint model, which shows how one company's default timing is related to another company's default timing. A type used. We use a Gaussian copula basically, which means that after we transform each firm's time to default into a standard normal variable, we assume those transformed variables are jointly normal. That's the key simplifying assumption, you can say, that makes the math work properly. Okay, so we have a multivariate normal distribution. And if this feels similar to Merton's structural model, you're absolutely right. Both connects default to underlying correlated random variables. Now, let's discuss the transformation process. The first step. The first step is to estimate the probability distribution of each firm's time to default. Let's call it QTI, the cumulative probability distribution of default. Okay. So it will tell whether the firm defaults by year 1 or by year 2. It's cumulative, just like we have done earlier. Okay. QTI is the cumulative default probability. So up to year T, what is the probability of default? Okay. Next, we apply what is called as percentile to percentile transformation. So we map those probabilities into a standard normal scale. The example has been discussed in other chapters also. So a 5% probability, if you have, it will become x equal to negative 1.645, corresponding to the fifth percentile of the standard normal distribution. Now, once we have transformed every company this way, we assume that all the x's together, okay, all of them, they follow a multivariate normal distribution. So the result is that the correlation between these x's, not the raw default times, is actually what defines default correlation in the Gaussian copula world. That's the beauty of this model. It separates each firm's individual credit profile from their correlation structure. Okay. Now let's take an example. Let's see how this looks in practice. Say we have 10 companies, okay, each with the same default probability curve. 1% in 1 year, up to 15% by year 5, and a correlation of 0.2 between any two pairs or any pair, sorry. So to simulate this, we first draw a set of standard normal variables, one for each company, from a multivariate normal distribution. Next, we convert those draws into default times by using the mapping that we built earlier. And then we compare these xi's to n inverse qt. And when x is less than n inverse qt, that is the threshold. So this process gives you a you can say, full picture of all the defaults across the company. So just we'll just continue with this example. Two tables have been built just for simplification purposes. You see what we have done over here. So cumulative probability of default up to that particular year, okay, has been given, and this n inverse qt, the corresponding n inverse qt, has been given. Okay, so you can see for 1%, of course, we know that n inverse of 0.01 is negative 2.33, right? Because 1% of the observations lie to the left of uh, the value negative 2.33 in a standard normal distribution. Okay, so this is the mapping which has been done, and we have built just another table just for convenience so that you can understand it better. In fact, we could have extended it in the same table, but we have just built it separately so that you can understand it in a better manner. Okay, now we need to compare for the against the threshold. So for year 1, the cumulative PD is 1% and it mapped to n inverse 0.01, which is negative 2.33. So if our simulated value of x is below negative 2.33, we'll say that the default happens in year 1. Okay. If the simulated value is less than negative 1.88, the default happens before year 2. But the good part about building the second table is that we can now compare. In fact, we can say that if x lies between negative 2.33 and negative 1.88, it means that the company survives the first year, but it defaults in the second year. Similarly, for year 3, at 6% and inverse is negative 1.55. So if x is between negative 1.88 and negative 1.55, it defaults in year 3. Similarly, for year 4 and for year 5. Okay. Then, of course, if x is greater than or equal to negative 1.4, 1.04, the final value, no default. Okay. It means that there is no default within this 5-year window. So each simulated x maps neatly into one of these interval. That's how Gaussian copula converts random normal draws into default timing outcomes for every single firm. Okay, so we'll discuss the one factor Gaussian copula model again briefly, because the mathematical part has been discussed in more detail in some of the earlier chapters. So before we look at the math, let's look at the intuition first. Okay, the core idea, you can say. Now there are two drivers in the one factor Gaussian copula model. Each firm's default timing is driven by two pieces. Okay, you have a systematic factor F that hits everyone, and a firm specific factor Zi that is unique to that firm. Okay, so we can combine these two into a single score for the firm. If that score drops below a credit worthiness threshold, you can say, the model will flag a default. Okay, so this is the formulation mathematically. Xi is equal to AIF plus under root 1 minus AI square Zi. Okay, F is this common factor, Zi is the firm specific factor. Both are assumed to be independent and standard normal variables. AI has this range, controls the sensitivity to the common factor, and higher AIs means that defaults will tend to move together. And we have also, in fact, if you remember in some other chapters and even in FRM part 1, this part has actually been derived. Why correlation between Xi and Xj is equal to AI Aj. We have done the mathematical derivation also, although it is not important. That is why I'm explaining everything in quite brief over here. Okay. Now, what about the default condition? Entity I defaults by time t if xi is less than n inverse qit, the same thing that we discussed in the previous slide. Okay, so that is the whole idea behind this one factor, the concept behind this one factor Gaussian copula model. Okay, so you have a threshold, then you have the core idea, then you have a compact formula which gives you a very clean and a scalable way to model correlated defaults. Okay, now based on the model, what is the formula for conditional default probability? So if we fix the common factor F, this is the conditional probability formula that we arrive at. Again, the mathematics is not important from this chapter's point of view. We've already done the mathematical part earlier along with some numerical examples as well. So I'll just repeat the interpretation which we have done in earlier chapters. So the interpretation is that if the value of F is higher, okay, it means that you can assume that the economy is doing well. In that case, the default probability will be lower. And if F goes lower, if F decreases, maybe during a recession or any other systemic stressed conditions, in that case, in fact, it can go so low F that it can also become negative. That also the model allows. So in that case, the defaults will actually cluster together. Okay, so that is the main idea behind the conditional probability formula. Okay. Okay, so credit VAR using Gaussian copula, as I said in the learning objectives part only, that it has been covered in the chapter credit value at risk, and in this chapter the coverage is exactly the same. So this part you can directly cover from that chapter. No need to do anything else over here. Okay, that's it for this lecture. So we have tried to cover everything in accordance with the GARP learning objectives. Study properly, study each and every detail. Okay. And after watching the video, make sure that you go through the PDF as well. Okay. Thank you so much. All the best. Namaste.